Okay, let's dive right into this. If you just glanced at the stock market on March 10th, 2026, you'd probably think, pretty boring day. But you would be missing the real story. Because underneath that super calm surface, a storm was absolutely brewing. So today, we're going to pull back the curtain and uncover the market's true feelings, its hidden panic, by using some really fascinating data from the options market.
And this right here is the central mystery we're unpacking. On the left, you've got the market's poker face. The S&P 500 barely budged, down just a fraction of a percent. But on the right, you see its racing heartbeat. A key fear gauge was screaming, hitting an extreme level of 1.949. So how is that possible? This massive disconnect signals a quiet panic that almost everybody on the street completely missed.
So how in the world do we measure an invisible feeling like anxiety? Well, professional investors have a special tool for this. It's called the skew, and it's how they gauge the market's real level of fear. Now, skew might sound a little technical, but the idea behind it is actually incredibly simple. Just think of it like this. It's the price of buying insurance against a big market crash. You know, when investors are feeling good and confident, that insurance is cheap. But when they get really scared, they start scrambling to buy protection, and the price of that insurance, the skew, just goes through the roof.
And on March 10th, get this, the skew for the SPY, that's the big S&P 500 fund, hit 1.949. Now that number wasn't just high, it was the single highest skew reading out of 42 of the most important assets in the entire market. That's a blaring signal that the pros were actively, and maybe even desperately, buying protection against a major drop.
This chart just says it all, doesn't it? I mean, look at this. A normal kind of chill market has a skew around 1.2. We were at 1.949. That is a dramatic leap. It tells us the market was secretly bracing for a big impact, even while the headline news was saying everything was fine. Which, of course, brings us to the million-dollar question. If the market wasn't actually crashing, what on earth was causing this deep, hidden anxiety? What were the big players so afraid of that they were paying top dollar for insurance? Well, the answer really boils down to one single dominant theme that was tying the entire market in knots. It was a really dangerous geopolitical game playing out between Iran, the price of oil, and of course, the stock market. This cloud of uncertainty was the primary driver of all that fear we were seeing in the data. So let's follow the breadcrumbs and see exactly how this tension started to show up. To find the source of the fear, we just have to look at the classic canary in the coal mine, the oil and energy sector. And the threat wasn't subtle. It was incredibly explicit. On that very day, Iran's foreign minister issued a direct warning about the Strait of Hormuz, which is, a critical artery for the entire world's oil supply. This wasn't some abstract risk. This was a clear and present danger to the global economy. You can literally watch the market react to this in real time just by looking at a huge energy company like Chevron. So over the weekend, its expected volatility, what we call IV, was pretty low and calm. Then, boom, on March 9th, news of a leadership change in Iran breaks, and the IV jumps. By the 10th, right after that threat about the Hormuz Strait, it had spiked to a high of 0.408. It's a perfect cause and effect timeline. And this wasn't just some isolated incident affecting one company. When you look at the stocks with the highest risk premiums across the market, who's right there at number 3? Chevron. This is all the confirmation we need that the options market was treating this geopolitical risk as a very real and very immediate threat. But here's where things get really fascinating. This fear wasn't contained. It didn't just stay in the energy sector. Nope. It started spreading like a shockwave, creating this chain reaction of warning bells across the entire market, hitting sectors that you might not even expect. And this visual just shows that ripple effect perfectly. Yeah, energy and geopolitics was the biggest piece of the pie, but look at everything else. Other huge sectors were flashing bright red for their own unique reasons. You had healthcare worried about contagion, consumer stocks getting hit by recession fears, and financials nervous about stagflation. The anxiety was definitely spreading. Let's just zoom in on healthcare for a second. The implied volatility for United Health, a gigantic insurance company, absolutely surged by 48% in just 2 weeks. This was all driven by fears that problems at one of their competitors could spread, plus a lot of uncertainty around government regulations. It was basically a perfect storm of sector-specific anxiety. Okay, so we've got fear in energy, we've got fear in healthcare, but the options market was sending out another signal, and this one was even stranger. It's something that happens very, very rarely, and it tells us that the market's anxiety isn't about the future. It's about right here, right now. So check out this table for the consumer sector.
Normally, people are more worried about what might happen 90 days from now than 30 days from now, right? That makes sense. But here, it's completely flipped. The 30-day volatility is higher than the 90-day. This is a super rare condition called backwardation, and it is a powerful, powerful sign of intense, immediate fear about the consumer in the next month.
So, let's get to the crucial point. What do we do with all this information? We've uncovered this hidden panic. We've traced it all the way to its source in Iran. We've seen its ripple effects. So, now what? How can we use these signals to be smarter?
Well, this whole analysis gives us 3 really timeless lessons. First, you've got to look beyond the headline numbers. They don't tell the whole story. Second, you need to learn how to read the price of risk using data like skew and IV. And third, once you can do that, you can use the data to pinpoint the specific epicenters of fear in the market. And the data from March 10th provides a fantastic framework for this. It tells us, hey, maybe manage your risk in really volatile sectors like energy. It reminds us to watch key earnings reports as a real-world test. And it even helps us spot potential opportunities by showing where that insurance is really expensive, like in Chevron, versus where it might be cheap, like in a stock such as Walmart.
So I'll leave you with this final thought. We've peeled back all the layers today and seen how a perfectly calm surface can hide a really turbulent reality. The market is always telling a story, but you have to know which instruments to listen to. So, the next time the major indices look quiet and boring, will you know where to look to find the truth?